Here's a number that's been sitting still since 2009. £325,000. That's the nil-rate band, the amount of your estate that passes to your family with no inheritance tax at all. It hasn't moved in 17 years, and the government has just confirmed it won't move again until at least April 2030. That single fact is why more ordinary families are paying inheritance tax than at any point in decades. Not because anyone got richer, because house prices went up, and the threshold didn't. Welcome back to Pension and Benefits Guide, where every week we take one piece of the system that affects people over 60 and break it down in plain English. If that's useful, hit subscribe, because today's update is a big one. Let's start with the basics. Inheritance tax is charged at 40% on the value of your estate above your tax-free allowance, not 40% of everything you own. That threshold is built from two allowances stacked together. The first is the nil-rate band, £325,000, which every individual gets. The second is the residence nil-rate band, worth up to £175,000. But here's the catch, it only applies if you leave your home to your children or grandchildren. Leave it to a niece, a nephew, or a close friend, and this allowance doesn't apply at all. Put both together, and a single person can pass on up to £500,000 tax-free. For married couples, unused allowances transfer to the survivor, so a couple leaving a home to their children can shelter up to £1 million between them. £1 million, that's the number everyone quotes. And for many families, that really is the end of the story. But here's where the real impact becomes clear: two hidden conditions can take that shelter away. First, it depends on who inherits the house. Two couples with identical estates can end up with very different tax bills. One leaving everything to children gets the full £1 million shelter, while another leaving their home to a godson or a nephew only gets the basic £500,000. Same wealth, same intentions, different outcome. Second, the residence allowance starts shrinking once your estate crosses £2 million, losing £1 for every £2 above that mark. It disappears completely at £2,350,000 for an individual, and £2,700,000 for a couple. That sounds like a lot, but between a home, a pension, savings, and maybe a second property, £2 million is closer than most people think. Now, here's the real headline of 2026, and almost nobody outside the finance pages has caught it yet. From April 2027, unused pensions will be brought inside your estate for inheritance tax for the very first time. Right now, your pension sits outside your estate and usually passes to your beneficiaries tax-free. That's about to change, and it's not just new pension savings, it's your existing pot too, if it's still unused when you die. For example, imagine a widow with £500,000 in her pension, untouched. Today, that passes to her children tax-free. From April 2027, that same £500,000 gets pulled into her estate, and up to 40% of it could now be taxed. That's not a small detail, that's a fundamental change, and it's happening in just 8 months. Quick pause, if this is useful, drop a like and let me know in the comments where your estate roughly sits. It really helps this reach more people who need it. There's a third change too. From April this year, unlimited relief for farms and family businesses was capped. Full relief now only applies to the first £2.5 million per person, with 50% relief above that. It shows the pattern clearly: allowances that used to protect everything now only protect the first slice. But the most important part is this: there's something that still works in your favor. You can give money away during your lifetime, and if you live 7 years after the gift, it falls completely outside your estate. This is the 7-year rule, one of the most powerful legal planning tools available. You can also give away £3,000 a year with no weight at all, plus small gifts of £250, wedding gifts up to £5,000, and regular gifts from surplus income with no limit. None of this needs new legislation, it's already the law. You just need to know it exists and keep a clear record. To sum it up with a quick picture, a widower leaving £1.4 million to his 2 sons gets the full shelter and pays nothing. A childless couple worth £800,000 leaving their estate to a nephew ends up paying tax on £300,000, simply because of who inherits. And a couple with a £600,000 pension, planning to leave it untouched, could see a big chunk of it taxed after April 2027. Same country, same rules, three very different outcomes, all because of one sentence under the headline number. One honest warning before the checklist: be careful of anyone who contacts you out of the blue offering an estate review. Seek advice yourself, from someone properly regulated. And to be clear, nothing here is personal financial or legal advice. Just an explanation of the rules as they stand. So here's your homework this week: work out what your estate is actually worth, check who your home is left to in your will, and if you have a pension you've been planning to leave untouched, talk to an advisor before April 2027, not after. Let me know in the comments, did any of these numbers surprise you? And if this helped, subscribe and share it with someone who needs to see it before the rules change. This has been Pension and Benefits Guide. Thanks for watching, and I'll see you in the next one.